All right, hey, welcome to Chapter 13. We're going to be learning how to account for corporations in this video. We're moving away from the individual and the partners and moving more in towards the group ownership of various companies. And so we'll deal with the corporations on that situation. Let's look at a little bit about the organization of the corporate company, whatever. It's an entity that's created by law. Ownership can be held publicly or privately. It can be transferred really easy. The company itself has rights, and I mean, as a sole proprietor, you're supposed to, for the business entity assumption, you keep yourself separate from the owner as far as your finances go. But if, as a sole proprietor or partnership, you die or you end the business, I mean, if you die or you stop working, the business stops, and it's just at least in its current form, and things have to change if it was a partnership. But with the corporation, everything's going to run whether the owners sell, buy, die, retire. I mean, it doesn't matter. They're going to continue operations, and that's the difference, really, a big difference between sole proprietors, partnerships versus a corporation. So here are some advantages and disadvantages, and the biggest disadvantage is that you're having corporate taxation. This is where you're getting double taxed now, and we'll talk a little bit about that as a disadvantage, but there's a lot of advantages to this. One of the main ones is that it has a continuous life. No matter what, the company is going to continue going on, of course, unless there's a going concern issue where the company goes bankrupt or something like that. There is no mutual agency for stockholders like there was with the partnerships. If I'm a owner of Nike, I have 2 shares of stock in Nike. I can't bind the company to a contract. You can get a lot of capital easier, as we're going to learn about in chapters 13 and 14 about how companies raise capital. I can easily give my stock, sell my stock to anyone I want, so there's no restrictions there. But let's talk about that corporate taxation. So what happens with the corporation is that they're going to be taxed at a corporate rate, and then that after that, when they distribute dividends to its owners, those dividends are taxed again. So that's what we're talking about when we're talking about double taxation. So when you hear a lot about people who are living on dividends and how they pay a lower amount, well, if they own, let's say 20% of a corporation, and they see this wealth accumulate in that company, before they see a dime, that all that is taxed. Then they get this money that's left over, 20% of it, let's just say, and then it's taxed again. Okay. So unlike a sole proprietor, where if the wealth builds in the company, they can take it all out and it's still only taxed once. The difference is owners of corporations has it taxed twice. Okay. Unless it's an S corporation, but those follow more the partners and other things, the way those work. So kind of a big hit there. Governmental regulation, there's a lot of regulation on C corporations. So let's look at corporate governance. All right. The sole owner and the head people that call all the shots are the stockholders. Okay. If you own stock in a company, you are an owner, you get to call the shots. And how you call the shots is by electing a board of directors. As a shareholder, you can run for a board of director position. Once the stockholders all vote on a board of directors, those board of directors will then hire a president or CEO, and then vice president, maybe some other officers. Then those officers work together to build the employees and keep the company going. So I want to be clear on this because there are a lot of questions about the corporate organization. The stockholders vote and elect the board of directors, and the board of directors hire the president or CEO and other officers. Okay, the treasurer of the board and all these other special positions of the board of directors are not the ones that will hire the president. It's the whole board that's going to do it. And also, I want to point out that it is the responsibility of the CEO that on how the day-to-day operations of the corporation run, but ultimate authority and responsibility go to the board of directors by a vote by the shareholders. Okay, employees of the corporation, while there may be managers, high-level managers, all the way down to the lowest paid person, they are the ones that are just doing the work, but they don't have a whole lot of responsibility compared to the president, vice president, CEO, CFO, etc. Okay. So just keep that in mind and don't let those questions kind of fool you. Here are the right of the stockholders. They can sell or dispose of stock at their leisure. When a stock issuance occurs, they can purchase a proportionate amount of additional shares. If any dividends are declared, you receive them. If for whatever reason the company decides to liquidate, anything left over is shared among all the other stockholders after preferred shareholders and creditors are paid in liquidation. And then, of course, there's always legal ramifications that could put people in different positions as far as if something were to go into bankruptcy or whatever. But for the most part, this is what we're looking at. Okay. And stockholders can vote at stockholders meetings. I do it by proxy when I vote. I really don't get involved a whole lot because I'm not as involved. Most of my stuff are mutual funds anyway, so I honestly don't even know what stocks I own. This is something really interesting that you can look at. This is a Green Bay Packers share of stock. You can Google any kind of company, and if they sell stock or have it out on the market, you can see what they look like. There's Minnesota Vikings are out there too. A lot of people like to look at Disney, things like that, but you can see this one was dated March 26, 1998. The certificate certifies that this person who owns this has one share of Green Bay Packers stock. And it looks like the face value, if you look up here, that looks like shares and the number. So it looks like I don't see any I don't see any face value on this, so I can't see unless this means it's somehow down here. But I'm pretty sure it's just restating that there's one share. Anyway, this is just one example of stock of what it looks like. But the bottom line is that's what we're looking at. Now, when you have stock, you have to understand that there are different statuses of what stock is, okay? So a corporate charter is what creates the rules regarding a corporation. In that corporate charter, it says how much a company can sell at any given point in total of how much stock can ever be sold. So if the corporate charter says that the corporation can sell up to 2 billion shares of stock, if the corporation has issued the 2 billion share of stock, that's it. In order to sell more, they'd have to amend the corporate charter. And doing that is extremely challenging and difficult, especially if you have 2 billion shares out there, because you have, depending on rules and things of the company, you may have to get a certain percentage of votes in order to do that. The more shares you sell, the more owners you have, the less amount of dividends potentially you could get. So it's not always a good thing from the perspective of shareholders to see more shares issued. But then there's advantages and disadvantages of shares of stock, and we'll get into that later on or in chapter 14. The par value is the amount signed to each share of stock, okay? And that par value will state how much it's worth. So most companies I see or know of in the last probably 20 years have issued their shares at 1 penny. And the reason for that is you can't sell stock below its par value. So if you have a $1 share of stock, but your stock is trading at 50 cents and you try to sell that stock for $1, no one's going to buy it. So you have to, in order to get people to want to buy it, you got to sell it at what the fair market value is, which is 50 cents, which is against the law. You can't sell it for lower than its par value, which is why most companies will set it at 1 cent. I've recently seen some set at 0.001 cent. I think when you get to that point, though, you start seeing a huge watering down of the shares of stock, and it's probably because there's been some maybe some reverse stock splits or maybe some stock splits. I don't know, but either way, there's been issues there, and it's probably something you want to look into more. No par value stock means that there isn't an amount issued on that stock. So that Green Bay stock could have easily been a no par value stock, so which pretty much is whatever you can get for it is the face value, and there is no consideration of excess par on the value of that stock. Stated value is no par value stock that is basically assigned a stated value, and that's just how it is. That's just what it is. When we deal with shares of stock, we're going to have when we sell them, if we sell them for above whatever the amount of stock face value is, we're going to have an amount that is additional paid in capital. It's the amount in excess of what is paid into the capital based on the stock, okay? So just regular paid in capital is the amount of the stock. Additional paid in capital is the amount of money you received in addition to the stated value on that stock. And retained earnings is going to be an accumulative amount of all the net income and loss, not distributed as dividends to its stockholders. This retained earnings statement is going to look awfully like the statement of owner's equity we learned in Accounting 111. Now, going back to the authorized stock, you have this little square here, and it's a really nice one. This is all of the shares that a company could ever sell at any given time. Now, if the shares are issued, that means that they have sold those stocks at some point. If the shares are outstanding, what that means is the company does not have control over it. So these in the middle here are the purple shares that people outside the company, or I should say, that are not owned directly or held directly by the company. These are the ones that are held by stock owners, mutual funds, things like that. These authorized and are issued but are not outstanding are what happened is we sold these stock at some point and we bought it back. Okay, so these are actually called treasury stock. And then the authorized stock are ones we just haven't sold yet but are authorized to sell up to if we ever get to that point. All right, so par value does not mean market value. The par value basically says if it's a penny a stock and you buy 10 shares, you spent 10 cents on this stock. Okay, that's just what it is. But its only value is 10 cents. If you spend $1 for those 10 shares, then your par value is still that 10 cents. The market value was that the 10 shares cost $1. So that's the difference there. Stockholders equity section. So you're going to have these new accounts. We're familiar with retained earnings a little bit because that's what we've talked about. We've called it owner's capital, but retained earnings is basically your owner's capital account. But we have this common stock and this paid in capital in excess of par. These are the two different kinds of accounts that we're going to be dealing with primarily in this chapter, but we're still going to be learning about the retained earnings as well. All right, so how do we issue stock? It's really simple. All we do is say, hey, we want to issue these stock. So let's look at this example. On June 5th, Dillon Snowboards Incorporated issued 30,000 shares of $10 par value stock for $300,000. Okay, so let's just calculate that. If we sell 30,000, we multiply that by 10, that's $300,000. Real easy, okay? Because this one is just saying that we have this $10 par value stock, multiply it by the number of shares we issued, and whatever that value is what we're going to put to common stock. It just happens to be the same amount as what we sold it for. So we have just a straight transaction here, debiting cash 300,000, crediting the common stock for 300,000. But what happens if we sold them for $12 per share? What we're going to still do to calculate our common stock is we're going to still calculate the number of shares, multiply it by the par value. That's still going to be what we get our common stock. But what this is going to do is it's going to leave us with an extra amount of money that is in excess of the par value of our stock, which is why we call it paid in capital in excess of par value. You see, as accountants don't make up clever names. We don't do it. So we're going to take, and we can calculate this one of two ways, all right? We can take this 30,000 shares, multiply it by 12, and that's the amount of cash we're going to get. Take the amount of cash, subtract out the 300,000, and that's our additional paid in capital in excess of par. The other way to do it is to take the par value and subtract take the $12 we sold per share and subtract out the par value, which will leave us $2 per share, multiply it by 30, and that'll still give us the paid in capital in excess of par. Either way is fine, but sometimes maybe they don't tell you what the total shares are and they only give you the full amounts, and you're going to have to do the backward math to get to it. But either way, you can calculate these as long as you have those factors in there. All right, issuing par value stock. All right, so when we do that, we're going to see our balance sheet, see an excess in our equity section and in our asset section. So here's our equity section after issuance. We had retained earnings of 65,000. I think we showed that before. Oh, no, we didn't. This is new. Okay, that's fine. And so our total stockholders' equity is $425,000. All right. So when we issue no par value stock, it just means whatever shares we issued at the price we sold it for is what it is. So debit cash 40,000, credit common stock no par value 40,000. Just that simple. Oh, I'm sorry. This was no. I'm so, yeah, that was no par value. This is the stated value. If we have a $40 stated value stock for $50 per share, anything in excess of that is going to be that same concept we just did on the first one. All right, we're going to get $50,000 cash, 1,000 times 50, and then to calculate our common stock is 1,000 times 40, and then we can just subtract the 40,000 from the 50,000, or take 50 minus 40 with $10 per share in excess of our stated value times 1,000. That's our excess of the stated value. All right. What if we issue our stock for something that is a non-cash asset? We still have to get value that exceeds our common stock par value. So in this case, if we're giving them 4,000 shares of $20 par value stock, we're going to see an $80,000 common stock hit. That means we have to get something at least that's worth $80,000. But we got land for $105,000, so we're going to debit land for $105,000. And then the excess of it is going to be excess paid in capital in excess of par for $25,000. It's just the difference between whatever the stock total times the par value is of whatever you received will be that paid in capital in excess of par. Now, I might say additional paid in capital, APIC. These are because that's what we called it when I was going to school with Moses. You know, when we were talking about how to make the books with our hammer and chisel, this is kind of what we come up with, and now they've changed it, the name of it, but it's all means the same thing, all right? So again, if I say additional paid in capital in excess of par, additional paid in capital, that's what I mean. All right. Again, issuing stock for non-cash assets. Again, maybe we had someone work for us, like a lawyer or something, and said, hey, we don't have money to pay, but hey, we'll give you some stock. How's that sound? Well, we're going to debit our expenses because that's what we are giving it for. And then we're going to give $9,000 worth of stock to this person. And then the additional amount, the $3,000, is going to be the paid in capital excess part. Basically, that individual did work for us worth $12,000. They received $9,000 worth of stock, and what they did for us was good enough to where we received a $3,000 benefit. Doesn't mean we're going to see the cash, all right? These are not. This is a non-cash situation, but that's certainly a certain something we can do. Okay. All right, so now we're going to talk cash dividends, and stock splits. These are really fun. I might need to break open for stock splits. I might break open Excel. We'll see if we need to get to there. But cash dividends, stock dividends, all these things are pretty straightforward math for us, all right? So when a company has excess money and they want to reward the owners for being an owner in the company and having their money in the company, they may send out a dividend, okay? It's going to be a reduction to our retained earnings, and we're going to have three very important dates that we need to know about. We're going to need to know about the date of declaration, the date of record, and the date of payment, okay? So we'll get to those here in a second. Right now, actually. All right, so our cash dividends, we have our date of declaration. That's when we're going to record our liability. We're going to debit our equity and credit our dividends payable. On the date of record, it's not an accounting date, but it's important for the company because whoever owns the stock on that date are going to get paid that dividend. But we don't have to do anything as accountants. The last thing we need to do, and the last date we need to worry about, is the date of payment. And what we're going to do is we are going to remove the liability by debiting the liability of dividends payable, and we are going to credit our cash account. Hey, Hadi. Okay, so you learned a little bit more about me than I anticipated because my wife called me. I thought I paused the video, and I ended up just pausing the screen, and you heard me talk. Anyway, show must go on, and I have no way to edit that out. So here we go. Anyways, we'll continue on. All right, so here's what happens when we have a date of declaration for a stock, cash dividend dated declaration. On January 9th, The $1 per share cash dividend is declared on Z Tech Incorporated's $5,000 common shares outstanding. That's the key. The number of shares outstanding, not issued, outstanding is what we're paying the dividend on. We're not paying the corporation a dividend on its own stock. Okay, we're not going to do that. So if they bought it back, we're only, we're not paying it on that. We're only paying on outstanding shares. The dividend will be paid on February 1st to stockholders of record on January 22nd. So when you do your homework and you're doing everything else, you're going to have three slots to do journal entries. Your first one is you're going to do a debit to retained earnings for the total amount, 5,000 shares times the par value, 5,000 shares times the dividend amount per share, which is $1. So 5,000 times 1 is 5,000. Debit retained earnings, credit common dividends payable. Or dividends pay. I mean, the book will probably want you to do dividends payable, but if you were to do it by hand and I were to see dividend payable just itself, I'd be fine with that. Then I have to say common. But that's our January 9th date. You in the book for January 22nd would need to indicate no journal entry required or no entry required for the date of record. Okay, so we don't have to worry about that. But on February 1st, we're going to record that payment. So of course we're going to credit cash because we're sending cash out, and we're going to debit our common dividends payable because we are reducing that liability to zero. We've paid it out. We've declared it back in January 9th. We're now paying it on February 1st. All right, so stock dividends. Why do we do a stock dividend at all? The reason for it is because if we do a stock dividend, we are going to, first of all, if we don't have the cash to give out, that's going to be helpful. Okay, we're not going to be able to have to dip into our cash reserves and things like that. But we also have the idea that if we do cash dividends, a lot of times the stock price will increase, and so we want to keep our market price affordable. So we're going to just issue the stock instead. And stock dividends say, hey, management feels like our company is going to do well in the future, and we're going to keep doing well. So having stock is actually a better thing because you're actually going to get a higher return on these shares than if you don't. So we have two different types, a small and a large stock dividend. Okay, if the distribution amount is less than or equal to 25% of total shares outstanding, then it is a small stock dividend. If it's greater than 25%, it's a large stock dividend. The question remains, why does we care whether it's a small or large? Well, how we handle it accounting-wise will matter, and that's why we're going to look at it that way, okay? So if we have a small stock dividend, let's say we have 10,000 shares of $10 par value common stock outstanding. I think I said 10,000 shares. If I didn't, I'm sorry. On December 31st, we declared a 10% stock dividend when the stock was selling for $15 per share. The stock will be distributed to stockholders on January 20th. So let's prepare the journal entries. What we're doing when we have a small stock dividend is we are going to be worried and needing to account for the fair market value of the stock. So what we're going to do is we're going to debit the retained earnings. We're going to take the 10,000 shares and we're going to, we're doing a 10% stock dividend. So we're distributing 1,000 shares. We're going to multiply it by the fair market value. 1,000 times 15 is going to be $15,000. We're going to debit that out of retained earnings. And then we're going to distribute that based on that. But we're still going to do a credit to the common stock distributable based on the par value of the stock. So we're going to take 1,000 times $10 par value is going to be $10,000. Then the remaining 5,000 will be the paid in capital in excess of par. So our liability only comes in that $10,000 that you see there. And when we go to pay it, we're going to, it's showing you here before. When we do a stock dividend, it's not going to impact our retained earnings. We're basically, our equity section, we're simply shifting our retained earnings into the common stock area. That's all we're really doing, and the paid in capital excess of par. When we issue that, though, and we actually pay it out or give it out, it's going to be a debit to the liability. The common stock dividend distributable is kind of like a liability. It acts as a liability, so we're going to treat it like that. And we're going to debit that when we give it out, and we're going to credit the common stock in its par value by the $10,000, the face value of the stock. Now, if it's a large stock dividend, though, we are going to not do the fair market value. We do not care about the fair market value. All we're going to do is take the number of shares and multiply it by the par value, and that's it. Retained earnings debit 30,000, credit to common stock, dividends distributable. And then when we're basically, oh, this is stock split. Basically, when we go to issue that, we're going to debit common stock dividend distributable for 30,000 and credit the common stock account for 30,000. So again, we're just transforming our retained earnings into more issued stock, and maybe in some, if it's a small stock dividend, some additional paid in capital. That's all we're doing when we do this. But it gives the stockholders more more shares. Which, if you do what we're about to talk about here, a stock split, the more shares you have, the better. God forbid that it's a reverse stock split, which I have experienced, and those stink. Okay, so I'm going to pause this and bring up Excel too, because I want to show it to you that way as well. All right, so what you're seeing here now, I have done an Excel spreadsheet. Let me zoom in a little bit more even. This is what's called a stock split. Now, why does a company do a stock split? Maybe the company's selling, the fair market value of the stock is too high. If you go online, you can find some shares of stock that are in the thousands of dollars. Well, you can imagine that doesn't mean that means that they're not going to be able to sell a whole lot of them. So stock splits can help with the volume of trades related to the stock. And ideally, if your stock is increasing, more people are buying, it helps also in a short run drive up the price as well. Which, on that note, if you're ever in the stock, if you're into stocks and you hear someone says, "Oh yeah, this company's a great one to buy," what they've done is, and especially if they have a lot of people that follow them, they've already bought that stock. They're telling you that it's a good stock. When you start buying, it's going to drive that price up. They're going to sell it high, and then it'll come back down at some point to some normal level. So whenever you hear someone say it's a great time to buy that stock, or that stock's a good buy, I will never buy that stock. That's just how I've done it, and I haven't done horrible. Although I did buy one, and that's probably what taught me this lesson. Maybe for another time or something, I'll tell you guys if you ask me about that. But it was kind of sad, but whatever. Just say, "Hey, Brian, tell me about the reverse stock split you've had." I'm like, okay. All right, so when we have a stock split, so before the stock split, our current situation is we have $20 par value. We have 100,000 shares. Our total equity that we're dealing with is $2 million. When we do a stock split, a 2-for-1, we're going to give you 2 shares for every one you have. What they're doing is they're saying we're going to take the par value of your $20 and we're going to divide it by 2 or multiply it by 0.5. And you're going to have a $10 par value. But we're going to multiply the number of shares that you have by 2, and you're going to have double the shares, just half the par value. What that does is it gives you your, what it does for the company, it doesn't do anything for them other than it might help the stock price. But their total equity section is going to stay the same, right? Before the stock split, it was $2 million. After the stock split is $2 million. But let's go ahead and let's throw in here fair market value, all right? Let's say the fair market value before the stock split was $50, okay? And so it's gonna be a multiple of dividing it by 2 or multiplying it by 0.5. We're cutting it in half. So it's gonna be a $25 fair market value now after that. So if you have $20,000 at $25, or 20,000 shares at $25, let's look at it this way, okay? So your shares, your fair market value, and so you have 100,000 shares at 50 here, and you have 200,000 at 25 here. So we can agree that right now they're equal, right? Okay, we're equal. Let me just go ahead and make this look better. Oops, no, I want it to go. I want to format this and then format paint these guys. Okay, there we go. And then let's format paint that so that we get, okay. So we both agree to this. Now, what if the shares go up $1? Let's say the shares go up $1. Okay, you have $5,100,000. You have $5,200,000 after the stock split. That's why a stock split is good. Because when it goes up by $1 now, you're getting more money. So what happens on a reverse stock split? Well, it's conversely to that. When the stock goes up by $1, you've earned less, and No, I'm not bitter. No, not even a little bit. So anyway, that's a little bit about stock splits. Okay. This is what we talked about. This is a great one to look at dividends and splits on how it works. Remember, just stock splits have no impact on the financial statements. None of these have any effect on assets or liabilities except on the cash dividend. And you can go through the rest of those, but that'll help you there. All right, so now we're going to be learning about preferred stock. What's the difference between the two? Preferred stock gets paid the dividends first, all right? And when we issue preferred stock, it's the same as kind of everything else. If we have a $100 par value, we sell 50 shares, we multiply that by that amount. So we have preferred stock at 5,000. If you sold it for more than it was worth, that's going to be additional paid in capital for the preferred stock. In this case, it's going to be $1,000. You receive $6,000 cash. So we look and see the impact on the equity section of the balance sheet. So we see that additional information for that. Okay. Now, why do we issue it? Well, we want to raise capital without sacrificing company control, because preferred stock don't have voting rights. Because they get dividends first, they don't have voting rights. And it also helps so that they don't gain have to pay interest on it if they were to issue liabilities or debt. So we have two versions of preferred stock, and I'm going to tell you this much: preferred stock is kind of a thing, kind of a not thing. It used to be more big. It used to be bigger, but I don't hear a whole lot about it anymore. There are some companies that still have preferred stock, but it's not as much anymore. You have two versions of it: cumulative and non-cumulative. What it means is when a company issues dividends, or they don't issue dividends in a given year, if it's a cumulative preferred stock, then they're owed that dividend in future periods. If it's non-cumulative, if no dividends were issued, they're not promised anything, and you just didn't get anything that year. Here's an illustration, but I'd rather walk through one with you in Excel, so I'm going to pull back that Excel spreadsheet. So let's look at it from this standpoint here. Let's go with, we issue, let's say 5,000, well, let's say we issued 4,000, let's say preferred stock par, and they give you a rate for the dividends. Okay, so let's just say it was a 10%. Just make it easy on me. So we have 10%. Oh wait, let's just do this. Rate 10%. Preferred stock par value. Let's say we have $200,000 worth of. Come on, little guy, go away. Okay, we have 200,000 shares of preferred stock at a rate of 10%. And then let's say it is 2020, 2021, 2022, 2023. Whoa. All right. So in 2020, if we're dealing with preferred shares, and these are cumulative, then in year 2020, we're owed, oops, let's do this. Let's do cumulative one higher and say amount owed, amount paid, in arrears. In arrears means it's owed from the past, available to common. All right. And I'm doing this in this lecture, so I'm not going to be doing it in a snippet. So if you like this format, you pause the video, set yourself up, and do it here. So preferred stock par value, we're going to take this, and this is the amount owed, and it's the amount owed every single year. So we're going to go ahead and do this. One more, Brian. And we're going to just copy that. Oops. Nope, see, I already messed up. We need to lock those cells. If you're not watching my snippets, you'd learn about locking cells and these other things already. So we're owed these every single year. So let's say, let's add a column here and call this Dividends declared. And let's say in 2020, no dividends were declared. 2021, no dividends were declared. In 2022, let's say $50,000 were declared. And then in 2023, $150,000 were declared. Okay. So the amount paid to the common, or excuse me, to the preferred stock um, is going to be zero. So in arrears is going to be our amount owed minus amount paid, which in this case is still 20,000. The next line, the amount owed minus or dividends declared. Actually, the amount paid is, instead of putting a zero here, we should do, well, no, we'll just put zero. Amount paid is zero still. So we're going to go ahead and we're going to do equals this plus or minus amount owed minus amount paid. Nope, that's not right. Hold on a sec. All right, I paused the video so that I could actually make this this spreadsheet work, and just so that you know, you can kind of come up here and see the formulas that I had to do to kind of get this to work. So these were this we call these nested ifs. I had to do a lot of these to get this to work right. So don't worry about trying to make one of these. If you can, great. But anyways, I could do one for the available account. So bottom line is, as long as there's anything in arrears, and this isn't right. See, I didn't even get them all right. $10 in arrears. This should be zeros in arrears, and then the rest is the 130,000 is available to common. So I'd have to still work on this model anyway. Just in the interest of time, I'm not going to spend the time. Bottom line is, you can see here that if it's cumulative, you have $20,000. If nothing is paid, then nothing is declared, then nothing is paid. Then it accumulates until they do pay. And this year they paid 50,000. We had 40,000 in arrears plus 20,000 owed the current year. So all of this should be 50,000. See, and then 10,000 is left. And then in the last year, because we don't have anything, well, we should have this actually should be 30,000, and this should be 120. So I apologize. I was trying to build a model. I love doing that. I just realized, hey, I don't need you guys to make this model anyway. Bottom line is, we're owed 20,000. We still had 10,000 in arrears. So dividends declares 150,000. 30 of it's going to go to cumulative, and then the rest is going to go to the common stock. That's cumulative preferred stock. Now, if it's non-cumulative, let's just take the same situation. I keep saying I'm sorry. I really hate too. So non-cumulative, what we're going to do is we're just basically going to say in arrears is not a thing, okay? So when dividends are declared finally in 2022, there's nothing extra owed to the to the preferred shares. So the amounts, available to the common is going to be more than what they would have got under the cumulative situation. So that is what you need to know about your preferred stock, okay? So the amount owed is going to be your face or the par value times the rate for the amount owed to this common stock or the preferred stock. Geez, too many stocks. If you have cumulative, you're going to have to make sure that if any of it didn't get paid, it's going to be accrued until it's paid off. And then anything remaining will go to the common stock at the end of that. That's all you got to know about this. And then the non-cumulative just doesn't accumulate and pays out whenever they can. All right. Let's go ahead and get ourselves back to the PowerPoint here and talk about treasury stock. Treasury stock is whenever a company issues stock and then buys it back. Brian, why would a company want to buy back stock? Well, there could be a couple reasons. The two most common are going to be, one, the company feels like the stock price is undervalued and or they know that something big is about to happen with their company. So they're going to buy back some of their stock at a smaller price. And when this big stuff happens, they'll reissue it at that higher price when the stock goes up. Another reason, second main reason I know of is whenever a company is going to issue stock options to a certain executive, employee, or somebody, they need to have that stock on hand to allow them to buy that at the time. So treasury stock is something that is dealt with and uses. You see that a majority of stock companies have treasury stock and what they do. There's also here's some other ones. The reasons why they might do that to maintain a strong market. Those are the things I was talking about. Avoid a takeover of the company. If the company owns more of its stock, they still have that control if the other company can't acquire them. So when we purchase our own stock, we purchase it at the open market or the fair market value. So in this case, Cyber Company is going to make a transaction of 1,000 shares of buying its own stock at $11.50. Simple. Treasury stock, common 11,500. Credit to cash, 11,500. Treasury stock is a contra equity account. Okay, it's going to go opposite its normal balances, but the treasury stock additional paid in capital does not. It's kind of one of those funky ones that just kind of plays out really weird. All right. So we bought these shares back at $11.50. We've got to remember that price, because when we go and sell this, are we selling it for the same? Yeah, we're selling it for the same amount. All we're going to do is just annotate however many shares we sold. We're going to credit the treasury stock worth the amount we sold and collect the cash. That's only if we sold it at what we paid for it. What happens if we actually sold it above cost? Well, now we're going to get that additional paid in capital for our treasury stock, $200. We've sold another 400 treasury shares at $12. We bought them for $11.50. We sold them for $12. So we have 50 cents per every share we sold. That's going to give us additional paid in capital that equates to $200. We're going to annotate the cash, and then we're going to credit the common stock for treasury because we're getting rid of that. Again, treasury stock for common shares or any shares is going to be a contra equity account, but the paid in capital for that treasury stock will not. It is a normal equity account. If we sold it for under its par value, or excuse me, under what we paid for it, then in this case, because we've already sold this amount here, the paid in capital, we have $200 in the paid in capital. When we sell it for under the amount, whatever we need to make up the difference for the actual price we paid for it for the treasury shares, we're going to pull out of paid in capital for the treasury stock. So in this case, we're going to dip into that additional paid in capital treasury stock by $150. We're going to have $50 left in there. Now, if by chance, I don't know if the next slide deals with it. Nope, it doesn't. So I'm going to talk about it now. If by chance we sell more of this stock at a cheaper price than what we got it for when we bought it back, we're going to dip into any of the additional paid in capital for that treasury stock. And if we still need to dip into more because we can't meet it, we're going to dip into retained earnings, and we're going to debit retained earnings to make that journal entry balance. Okay. All right. And then we'll cover some of that in the homework if you want to go ahead and look at that. So explain items reported in retained earnings. Okay. This is, again, basically your owner's equity financial statement. Okay. The statement of retained earnings follows the exact same method here. All right. You have your beginning balance. All right. You're going to have any prior period adjustments. Let's not worry too much about that. So you have your adjusted retained earnings. You're going to add in net income. You're going to subtract out your dividends declared. And then you're going to have your ending balance. What is net income? Well, net income is net income, right? Our owner's equity account is beginning balance plus owner contribution plus net income minus withdrawals. What is dividends? It's a type of owner withdrawal from the corporation. They're getting this dividend. The only difference is the owner does not have control to pull the money out. It's got to be declared by the board of directors and the CEO of the company. So it's basically the same thing. It's just called by a different name and has different words on it. Okay. So, but your statement of retained earnings mirrors almost identical to our statement of owner's equity from Accounting 111. When we're looking at the entire statement of stockholders' equity section, we can look at this worksheet. This calls it the statement of stockholders' equity, of course, but we're looking at how everything changes over time. We look at our beginning balance, and then we look at everything else. Net income, we got that into retained earnings. Issuance of common stock, we're putting that in the common stock and the additional paid in capital. Okay, technically that could be considered the owner contribution that we're not going to do in retained earnings. That's like the main difference between this because it goes into these special other accounts. But then we're going to have purchase of treasury stock and then cash dividends. And in the far right side of it, we have that total equity. It's basically explaining what happened in that accounting period. All right. And then the last thing here we're going to look at is earnings per share, price earnings ratio, and dividend yield. These are, again, ratios. You're going to be looking at some of these at the end of the semester to do your project. Okay, so know these things and know how to explain what they're telling you so that you can present this stuff. But earnings per share is one of the things that we want to look at. Basic earnings per share, and then you're going to have diluted earnings per share. I don't know if we're going to get into that here, but I can't remember if the slides has it or not. Yeah, it doesn't. So don't worry about diluted earnings per share. Basically, we have net income minus preferred dividends divided by your weighted average of your common shares outstanding. The weighted average calculation for your common shares is you just take every time it purchased or issued more shares or whatever, and you take the weighted average of that based on the number of months they were outstanding. Okay, I'm not going to make you calculate the earnings per share. I don't even think that's one of them, but just know it's there. The price earnings ratio, however, is something you'll want to know. You take your market value price per share and divide it by your earnings per share. Your earnings per share is calculated by net income divided by your total number of shares. That's your earnings per share. That's what you're going to calculate there. That's going to tell you how much, whether or not your price is a good price. And then your dividend yield has your annual cash dividends per share divided by your market value per share. So it's really easy if you're not issuing dividends. It's 0 divided by whatever, okay? And it's just 0. All right, but if you're issuing dividends, your annual cash dividends divided by your market value per share, this is kind of you're using a and it's probably the market value per share is going to be your December 31st date, and your annual cash dividends per share is going to be the whatever you've issued over that year. So it's kind of a mix of those of the income statement and the balance sheet to give you your dividend yield. All right. So with that, that's it for chapter 13. Before we go, let's get you your word, and it should be Hottie since you guys got to hear my fun way of answering my wife, the phone when my wife called, but it's going to be Jim, like Slim Jim, 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 Jim. That's your word. Please enter it in so you can get your credit for watching the video. You guys have a great day, and we will see you later on in other videos, and have a good one.